Hello guys, I'd like to welcome you in the Flipping Markets video course. First of all, I want to introduce myself. My name is Marcel, aka Flipping Markets. I live in Hungary and I'm a session trader, which means I only trade New York Kill Zone. I created this video course to help you in supply and demand trading. I will keep this course as simple as possible because we all know that simplicity is key in the Forex game. There's no need to ever overcomplicate things, especially trading. That's why I kept my PDF and this video course simple. By the end of this course, you'll get a deeper knowledge about the supply and demand trading, and you have a great chance to become funded in a short period of time. So enough of talking, let's just begin. So welcome everyone in the first video. This unit will be about the supply and demand zones. As I said in the intro, I keep this course as simple as possible. First of all, what do we call a supply and demand zone? It's a zone where price rapidly pushes away from, so lots of orders were placed, creates inefficiency. Please pause the video now and check the inefficiency video before you continue to watch this, because it's necessary to check that video before you continue to watch this. So please just pause it and watch the inefficiency video. Okay, move on. It has to break structure or change character. We'll talk about change of characters in the entry unit. And finally, it has to create or collect liquidity. So we have three criteria for a supply and demand zone. And please grab a piece of paper and write it down, because it will be very, very important in the future to write these three criteria down, because you'll be able to identify the zones based on these three criteria. Okay, so the first criteria is, write it down, it has to create inefficiency. We call it IFC from now. Without inefficiency, the zone would be less valid, because zones with IFC attract buyers. So price has a greater chance to tap the zone with IFC than without IFC. Okay, the next criteria is it has to break structure or change character. A supply and demand zone will only be valid if it breaks structure or an opposite side zone. Let's see an example for this. Okay, let's see an example. As you can see, I just drew a higher high and higher low structure here, which is bullish. It creates a break of structures to the upside. Okay, as I said, price has to create inefficiency in order to create a valid demand zone or supply zone. Let's say this move created inefficiency. You won't see it here because you'll only see it in the live charts. But let's say this created inefficiency. As you can see, this broke structure to the upside. So it will be a valid demand zone. The third criteria will be it has to create or collect liquidity, but we'll talk about that later. Okay. We have the first demand zone right here. As you can see, price created another break of structure here on the upside. And let's say this also created an inefficient move. Okay, we have the second demand zone right here. After that, price created a little structure, a little pullback, and reached its high. After the high, it changed character to the downside here. So after a change of character, price will automatically create a zone, either if it's a supply or demand zone. But we'll talk about change of characters in the entry units. Okay, so after a change of character, price created a supply zone because it's a change of character to the downside. So this means supply is in control now. I will just draw a supply zone right here. And supply took over control because it broke the last demand zone, which was here. Okay, if price reacts on this zone, on this demand zone that created inefficiency and break of structure to the upside, price reacts on this zone and breaks through the opposite side zone. So this supply zone, that's why I meant by breaking through an opposite side zone, then it will become valid again. It will become a valid demand zone because let's say it created inefficiency with the movement and broke through an opposite side zone. So yeah, let's move on. Okay, so the third or the +1 criteria is the liquidity creator sweep. I said +1 because it's not necessary to create or sweep liquidity in order to form a valid zone, but it's a really, really strong confirmation. So the first and the second criteria has to happen in order to form a valid zone. So the break of structure and the IFC, it has to happen. But the third, so the liquidity sweep, is just a confirmation. Okay, we'll talk about liquidity sweeps deeper in the liquidity unit. Let's see the criteria on these examples. So the first one is a long example. As you can see, price, let's say, created an inefficient movement to the upside because you won't see inefficiency on this line. But let's say with candles, it created inefficiency. First criteria is fit. This was the last high point. This was the last low point. Price with an inefficient movement broke through the last high point, so it broke structure to the upside. So the second criteria is fit. Let's see the liquidity sweep will collect. We had liquidity trend line here. We'll talk about liquidity trend lines in the liquidity unit. So we have liquidity trend line here. Price swept the liquidity trend line, collected liquidity from above, and it created another liquidity on the way down. So it has double liquidity confirmation because it swept liquidity and created liquidity. So all of the three criteria are fit: inefficiency, break of structure, liquidity. Okay, the same goes on for the bearish structure. As you can see, price has a high point and a low point. Price did a pullback and created a break of structure to the downside. With impulse movement, let's say we have inefficiency here again. It broke structure because it broke through the last low point. It collected liquidity because we had a liquidity trend line here again. So price swept all of the liquidity from this trend line. Price created liquidity on the way back down to this zone. So it created liquidity and swept liquidity again. So all of the three criteria are fit. Let's apply these criteria on the live chart. So we are on the live charts right now on the 4-hour. As you can see, price was in a bullish trend. And after the bullish trend, price broke this trend and started to form series of lower lows and lower highs. So this means we are in a bearish trend right now. Okay, in a bearish trend, as we know, price will form supply chain. So supply zones over and over again being respected. This is a supply chain. Okay, let's find the supply zones. First, map out our structure. As you can see, we had the last high point right here and the last low point right here. Price broke structure to the downside with this movement, inefficient movement. So first criteria is fit because it broke structure to the downside here. Second is fit because it created inefficient movement. And the third criteria is fit because it swept liquidity. We have liquidity here. So price just swept that liquidity. And as you can see, price levitated back up to this supply because this will be our right supply zone. So price levitated back up to this supply and reacted on it. So I will just mark the structure. Price is currently moving in this range. We have a high and a low. As soon as price breaks this low point, it will create a break of structure. So one of the three criteria will be fit. Okay, let's see what will happen. It's moving in the range. Okay, it created inefficient movement, but it didn't break below this low. As you can see, this is inefficient movement. Okay, it broke below the low. So we have a new supply zone because it created inefficient movement, break of structure, and actually it didn't sweep any liquidity, but this is a really huge inefficiency. So this will be a valid zone. So let's just mark out the candle. We are waiting for this candle to be tapped or the last low to be broken. So this is our last low and this is our last high right now. As soon as this low breaks, we will create a break of structure and we will more likely to have another supply zone. Let's see what happens. Okay, as you can see, price created another inefficient movement to the downside and broke structure. So this means we have another supply zone, which is up here. Okay, let's play price. Waiting for a pullback. Okay, the pullback happened. So we are currently moving in this range. As soon as this low breaks, it will create a break of structure to the downside and will form a new supply zone. Wait. Okay, as you can see, price created another break of structure to the downside. So we have a new high. Sorry, we have a new high here and we are waiting for a new low. And this means we have a new supply zone also. I will use the wick, but I will explain later why did I use the wick in the wick explain video. Okay, let's just continue. As you can see, price created a new low, which is right here. We are waiting for a pullback. Price tapped the zone. Price reacted on that zone, created inefficient movement to the downside, but didn't break below the last low point. And it broke below because all of these breaks were just weak breaks. So I will count this as a real break structure because it broke below the zone with body closer. Okay, let's just mark out this zone. This will be our new supply zone. And this method gives on and on over and over again. You can mark out supply zones and demand zones based on these three criteria: inefficiency, break of structure or change of character, or opposite side zone break, and liquidity sweep or collect. Okay, let's see a demand zone example. Okay, as you can see, we are on the 4-hour chart again, and price is in a clear bullish trend because it's creating break of structures to the upside and forming series of higher highs and higher lows. So this is a clear bullish trend. Okay, before we continue this, I will ask you to watch the weak zones video because you will need it to complete this task. And actually, I will give you your first task. I want you to mark all of the demand zones out on this structure. I will give you 1 minute for this task. Let's begin. So the 1 minute is over, and as you can see, I drew all of the zones that has at least 2 criteria: liquidity collect, break of structure, and inefficiency. Okay, let's check them out. As you can see, this is our first zone. We call it as an extreme zone because it was the start of the whole order flow. Okay, this zone changed character here and here, so this will be valid because it created inefficiency and swept liquidity. The next zone will be this one because it, as you can see, created inefficiency. It has a gap between the wicks and it broke structure, broke this structure. Okay, the next zone will be this wick zone because it created inefficiency, huge inefficiency, broke structure to the upside and collected liquidity from this region. As you can see, here's another zone, this small zone, because it created inefficiency to the upside, broke structure, collected liquidity. Price reacted on this zone here and just broke below a little bit. But after the broke below, price created this demand zone again, broke structure to the upside, created inefficiency, and it didn't collect any liquidity, but it will be a valid zone. After this, price broke structure to the upside here with this candle, created inefficiency, and swept liquidity from this region. Okay, let's move on. Welcome. This video will be about the inefficiency. What does the inefficiency mean? It means the gap between the wicks in an impulsive movement. If price moves rapidly, printing several candles, and the wicks between the candles doesn't meet, it will be inefficient. So as you can see, price is printing several candles here, and the wicks between the candles, so this one and this one, doesn't meet in the middle. So this gap between the price is inefficient. So basically, inefficiency means gap between the wicks. Okay, here you can see an example for an efficient price. As you can see, several candles has been printed, and the wicks between the candles meet in the middle. So there's no gap in the price, there's no inefficiency in the price, so this one is efficient. Okay, but how can we actually use this to our advantage? When the market moves rapidly and leaves inefficiency behind, price usually fills the created gap to restore the balance. Assigning inefficiencies and combining them with supply demand zones can make you avoid a lot of early entries and can save you from unnecessary losses. Okay, so let's see the example. Price is moving in a downtrend, as you can see. In this region, price created inefficient move. So there's a gap between the wicks. So this means there's imbalance, there's inefficiency. Above this inefficiency, you can find the supply zone right here, because this supply zone created inefficient movement and broke structure through downside. Let's say price creates another pullback. And after the pullback, it creates another supply zone and breaks structure to the downside. But this supply zone has no inefficiency below, just like this. So price has a greater chance to levitate back up to this supply zone and react on this than reacting on this one. Because if there's inefficiency, it will work like a magnet. It will magnetize the price back up to that zone and fill up the gap between the wicks. So if you see something like this, one inefficiency and one efficiency, you will aim for the inefficiency because it has a greater chance to reverse the price than this efficient movement. So let's see the live example. As you can see, price is currently moving in a downtrend, so creating a series of lower lows and lower highs. Let's focus on this region. As you can see, price created a breakout structure to the downside with this candle. After that, it created inefficiency, so there's gap between the wicks. This area needs to be filled. Price has a great chance to levitate back up to this supply zone, react on this supply zone, and continue the bearish trend. This is exactly what happened because price reacted on this supply zone, broke structure to the downside here. It's a breakout structure and created another inefficient movement. So as you can see, inside of this supply zone, price created another supply zone, which is right here, because this supply zone caused the inefficient movement. So there's a gap between the wicks again, here and here also. So price has a really great chance to come and fill this inefficiency up before it continues the overall bearish direction. So as you can see, price the breakout structure on the downside here again, but this is efficient because this week and this week meets. So there's no inefficiency in the price. So it has a greater chance to fill up this void here and react in the supply zone. And after the reaction on the supply zone, it can continue the bearish trend. Okay, so I want you to practice inefficiencies. I'd like to give a task for you. So mark all of the inefficient areas between this line and this line. So in this region. For this task, you will need an image editor program or just a TradingView. And you have to screenshot this image and copy and paste into TradingView. I would like to ask you to mark all of the inefficient areas, and I will just show you an example. For example, I see an inefficient area here. I just press my highlighter and mark it. I would like to ask you to do the same with all of the inefficient areas. I will give you 1 minute for this. Okay, so your time is over. And as you can see, I marked all of the inefficient areas between the red lines. So if you see a yellow highlight, that means we have an inefficient gap there. As you can see, on all of the yellow lines, we have an inefficient gap between the wicks. So the areas are inefficient. It will take some practice to notice all of the inefficiencies on a chart. So if you watch this video, I would like to ask you to open TradingView and just practice the inefficiencies and train your eyes to see them. Okay, see you in the next video. Hello, welcome in the next video. In this video, we'll talk about how to choose the best supply and demand zones. As you can see in this example, price is creating series of higher highs and higher lows. After the last high has been created, price did a pullback, and after the pullback, price broke structure to the upside with inefficient movement. So, how would you choose the best demand zone in this case? In order to find the best demand zone, you will have to find areas where IFC has been created. Okay, you will have to find the less recent candle before the inefficiency. Which is the less recent candle before the inefficiency? It's this downside candle. So as you can see, this downside candle was the less recent candle before the inefficient push to the upside. So in this case, this downside candle will be your right demand zone. You will expect some confirmation or long entry on this zone. But let's see what happens if the less recent candle before the inefficient push isn't the downside candle in the long example. So as you can see, price did a pullback, but the less recent candle before the inefficient push is an upside candle. You don't need to be scared. This will be your right demand zone again, because it doesn't have to be an opposite side candle. So yeah, in this case, you will choose the less recent candle again before the inefficient push to the upside. So once more, your right demand or supply zone will always be the last recent candle before the inefficient push. This is the #1 rule. Let's see another example. In this case, price is creating a series of higher highs and higher lows again. After the last high has been created and the pullback happened, price started to slow down and started to create efficient movements. As you can see, all of these movements are efficient. The inefficiency came into the market with these candles. So in this case, we won't choose the last opposite side direction candle, so this zone, because it didn't create any inefficiency. Which candle created the inefficiency? This one again. So the last recent candle will be your right demand zone or supply zone before the inefficient push. So always choose the last recent candle before the inefficient push and the break of structure. As you can see, this structure has been broken by this candle and by this inefficient push. So this will be your right demand per supply zone every time. So let's see a live example for the best zone selection and the inefficient push. So as you can see in this region, price created a pullback with this candle, and after that, inefficient movement happened by these 3 candles. Which zone caused the inefficient push? It was caused by this downside candle. So this will be our right supply zone. And as you can see, we have an upside candle before this candle, but this upside candle didn't cause the inefficiency. The inefficiency was caused by this supply zone, by this downside candle. And as you can see, after this candle, the inefficient push came into the market. So this will be our right supply zone. Okay, let's talk about the long examples. As you can see in this region, price is creating a series of higher highs and higher lows. Let's start from this region. As you can see, the inefficient push came into the market here. So we have inefficiency here. We will have to find the last recent candle before the inefficiency has been created. Which is that candle? It's this one. So this will be our right demand zone because it broke structure to the upside, it created inefficiency, and it swept liquidity from this region. So this will be a really strong demand zone. Let's see another demand zone. As you can see, an inefficient push happened here again. And before this inefficient push, price created a pullback. So this will be a downside candle before the inefficient push. So this will be another right demand zone because it broke structure to the upside again, created inefficiency, and actually created liquidity here, just above the zone. Okay, let's find another demand zones. So as you can see, price broke structure here to the upside, created inefficiency here. So we will have to find the last recent candle before the inefficient push. This candle is the last candle before the inefficient push. So this will be our right demand zone. As you can see, price broke structure to the upside here again. And we have inefficiency here. We have to find the last recent demand zone before the inefficient push and break of structure, which will be this one. And this goes on and on and on again. This is a really, really simple rule. You will always have to find the last recent candle before the inefficient push. Let's talk about the weak zones. As you can see, in this scenario, price is moving in a downtrend. After the high and the low has been created, price started to form pullback phase. This pullback phase is efficient, as you can see. After the pullback phase, price created a break of structure to the downside with inefficient movement. So these 3 candles are inefficient. This is the only scenario where you can't use the last recent candle before the inefficient push because this candle is already mitigated by the following wick. So in this scenario, you will have to use the wick as the supply zone because the orders are sitting on this candle, this wick, and not on the last recent candle before the inefficient push. So this is the only scenario where you can't use the last recent candle before the inefficient push. Just think logically. Where are the orders sitting? They are sitting on this wick. So the orders have been placed on this wick because this wick caused the inefficient push to the downside. This last recent candle by the inefficient push is already mitigated by the following wick. So once more, this is the only scenario where you can't use the last recent candle before the inefficient push. Okay, let's see a live example for this. Okay, so let's see the live example of the weak zones. As you can see, price is moving in a clear downtrend because it's forming highs, lows, lower highs, and lower lows. So let's just focus on this region. I will just zoom in. As you can see in this region, price has created inefficient move to the downside. So it's a real inefficiency. Also, this inefficiency broke structure to the downside here. So it's a break of structure. Okay, what should we do in this case? Normally, we will look for a less recent candle before the inefficient push and the break of structure. And the less recent candle will be this one. Because this candle is inefficient, this candle is inefficient, and this is inefficient. So the less recent candle will be this. But in this case, this candle has been already mitigated by the following candle's wick. So the orders are sitting on this wick and not on this candle, because this candle has been already mitigated. So in this case, this will be our right supply zone. Hello, welcome in this video. This video is about the mitigations. What is a mitigation? When price taps into a supply or demand zone that has not been tapped yet, it becomes mitigated from unmitigated. What does it mean? If you have a supply or demand zone, there are loads of orders sitting on those zones placed by algorithms, banks, and retail traders. When price taps the zones, the resting orders are getting picked up, so it's becoming mitigated from unmitigated. A zone can be only mitigated once because orders can be picked up twice, but a price can form another zone inside of the old one. But okay, that's enough of theories. We don't really want to overcomplicate things. Forex trading is hard enough, so let's keep the theories and analysis simple. Okay, let's see an example for the mitigations. Price is moving in an uptrend, so it's creating series of higher highs and higher lows. If price moves in an uptrend, we are expecting the demand taps. Let's say this demand zone was created because it created inefficient move to the upside, broke structure, and swept or created some liquidity. So this demand zone will stay unmitigated unless price taps into this zone and collects all of the orders that are resting on this zone. If price steps into this zone, it will become mitigated. Okay, let's say price stepped into this zone, mitigated the orders, collected the orders, and after the mitigation, price created another break of structure to the upside, inefficient move, created or swept some liquidity. In this case, price will create another demand zone that will stay unmitigated unless price taps into this zone. If price taps into this zone, it will become mitigated again. This is how mitigations work. This is a demand chain. Okay, let's see a live chart example for the mitigations. As you can see, price is currently moving in a downtrend, creating series of lower lows and lower highs. So if price is moving in a downtrend, we are expecting the supplies to be formed and the supplies to be mitigated. So if we see a downtrend, we will see supply zones and we will see the mitigation of these supply zones. So if price steps non-mitigated supply zone, it will become mitigated. So all of the orders were collected. Let's see the live example, and I will just play price forward. As you can see, price created inefficient movement to the downside. It broke structure here. So we will have a right supply zone, which is this one, because this candle created the inefficient movement and the break of structure. So right now, this zone is unmitigated unless price steps into this and mitigates the zone, so collects all of the orders. Let's see what happens. As you can see, price tapped this zone, so it became mitigated. Let's play price. As you can see, price broke structure to the downside again here and created inefficient movement, and the inefficient movement was created by this wick right here. Okay, we are expecting the tap of this supply zone now. Price tapped this supply zone, mitigated it, collected the orders. So right now we are expecting another break of structure to the downside. As you can see, another break of structure happened here. Another inefficient movement happened, and the inefficient movement was caused by this candle. Actually, we could use the upside candle before the inefficient movement, but this is a refinement. We'll talk about refinements in the later units. And the inefficiency was caused by this candle, and the break of structure was caused by this candle too. So this will be the right supply zone. This supply zone will stay unmitigated unless price comes back up and taps into this zone. So it will collect the orders and it will become mitigated from unmitigated. Okay, let's see what happens. As you can see, price mitigated the zone again, collected the orders, so this became mitigated. And this will go on and on and on. This is a supply chain, and this is a mitigation. So let's see another example. As I said earlier, zone can be only mitigated once because orders can be picked up twice, but price can form another zone inside of the old one. So I brought an example for this one. So as you can see, price is moving in an uptrend, creating inefficient movements to the upside and breaking structures. So this means we will have a right valid demand zone. Price came back down to mitigate this zone, collected the orders, and after the order collection, it created a change of character to the upside. So we will talk about change of characters later, but as I said earlier, if a change of character happens, price will automatically create a new zone. So this could seem like price created a zone and it mitigated that zone twice, and after the second mitigation, price blew up to the upside. But it didn't really happen because price created a new zone inside of the old one. Because price mitigated the old zone, and after a mitigation, it created a change of character. So it immediately created another zone. So this another zone, this new zone, will be inside of the old bigger zone. So this seems like it's a second mitigation, but it's not a second mitigation. It's a new zone mitigation. Okay, so let's see an example for that. How can we use the unmitigated and mitigated zones for our advantage? So as you can see, price is extremely bullish, creating series of higher highs and higher lows. And price created this demand zone right here. This demand zone is valid because it broke structure to the upside, so it broke to the last structural point, created inefficient move, but it left unmitigated because price didn't come back down to mitigate and collect the orders. So we will have this zone as our turning point, and we are expecting some reaction on this zone. And after the tap of this zone and the mitigation, we will expect the reversal point, so change of character to the upside, and the continuation of the longs. Okay, price reached its high point here, and after the high point has been reached, price broke structure, change character to the downside. So as I said, change of characters will always create a zone. So this supply zone has been created, but it left unmitigated also, because price didn't come back up to mitigate this one. We will use this supply zone for our target point later. Okay, as I said, we are expecting the tap of this demand zone, mitigation of this demand zone, and reversal on this zone. Let's say price comes back down to this zone, mitigates it, and after a mitigation, it creates a change of character to the upside. And as I said, change of characters will always create a zone. So we have a change of character here. And don't worry, we will talk about the change of characters in the entry units. So we have a change of character, and we created another demand zone because the change of character will always create a demand zone or a supply zone. So as I said, we are expecting the continuation of the bullish trend. So price mitigated this big demand zone. And after the mitigation, it created a change of character, reaction on the freshly created demand zone. And after this, we can use the unmitigated supply zone. So this one for our target point. Hello, welcome in this video. We'll talk about the who's in control topic. This is one of the most important things to master in the supply and demand trading. Understanding if supply or demand is in control can help you to avoid a lot of unnecessary losses. How does this system work? It works based on simple mitigations. If price mitigates a demand zone, demand will take over control supply. If price mitigates a supply zone, supply will take over control demand. You always want to trade the controlling side of the market. So let's see an example for this. As you can see, price is moving in a downtrend here, creating a series of lower lows and lower highs. Price created a break of structure here with an impulsive, inefficient movement to the downside. So this means a supply zone has been formed here. Price didn't come back up to mitigate this zone, so this zone has been left unmitigated. Okay, after this, price created this pullback here, and after this pullback, broke structure to the downside again. This means we will have another supply zone, which is right here. After this, price broke through this supply zone, so this means demand took over control from supply. And as I said in the earlier videos, if a zone breaks, then an opposite side zone will be automatically created. So if this supply zone breaks, that a demand zone will be created automatically. Okay, price broke structure, mitigated this zone, broke structure to the upside again, created this fresh new demand zone, mitigated this fresh new demand zone again, broke structure to the upside again. This means we will have another demand zone, which is this one. This demand zone also left unmitigated. So after this movement, price did a small pullback here, and after this pullback, price broke structure to the upside again. This means we will have another demand zone, which is right here. But in this case, price tapped into this supply zone. If price taps into a supply zone, when demand is in control, and it rejects on that supply zone, supply will take over control from demand. Okay, let's see, we have two scenarios here. I mean, basically 3 scenarios. The first one, if price breaks through this supply zone without a rejection, demand will be control and supply did not take over control. The second one, price rejects on this supply zone and taps into this demand zone. So on the tap of this supply zone and rejection, supply took over control from demand. But if price taps into this demand zone and does a rejection on it, then demand will be control again. Okay, the third, if price rejects on this supply zone and breaks through this demand zone, supply will be fully in control and the new supply zone will be formed because, as you know, if a zone breaks, then an opposite side zone will be automatically formed. So a supply zone will be formed here and supply will take over control from demand fully. Okay, let's see a live example for the who's in control topic. We have a supply zone up here because let's say it broke structure to the downside with this inefficient movement. After the structure breaking movement, price did a pullback and created liquidity here, which is double bottoms. After this, price broke structure to the downside with this inefficient push, as you can see. So we have all the 3 criteria in order to form a valid supply zone. So first criteria, price swept liquidity. Second, it broke structure. Third, it created an inefficient move. So we have a valid supply zone, which means supply is in control. Okay, after this, price tapped into this demand zone and had a strong rejection in it, which means demand took over control from supply. But it isn't a full control because, as you can see, we still have this supply zone up here. And if price taps into this supply zone and reacts on it, supply will be in control again. If price breaks through this supply zone, demand will be fully in control. But in this region between the demand and between the supply zone, demand will be just partly in control. Okay, as you can see, demand was partly in control, reacted on this supply zone, had a rejection, which means supply took over control from demand again. After this, price broke through this supply zone and created a demand zone that did a supply breaking movement. This means demand is fully in control now. But we have a supply zone up here, which was the extreme of the move because it started the whole bearish order flow. And the price actually tapped this supply zone, which means supply took over control from demand again. And as you can see, we have this last demand zone right here, which created the inefficient movement and the breakout structure to the upside. And price broke through that zone with this movement, with this inefficient movement after this supply tap. So what do we know about zone breaks? If a zone breaks, then an opposite side zone will be automatically created. So if a demand zone breaks, which is here, a supply zone will be created, which is here. Sorry. So this week started the inefficient movement to the downside and the breakout structure. So this means this week will be our right supply zone. As you can see, price came back up to this supply zone, mitigated this supply zone, and reversed the price again. So this means supply is in control in this region. And this goes on and on again. Okay, as I said in the beginning of the video, you always want to trade the controlling side of the market. So supply was in control because it was creating series of lower lows and lower highs over and over again, forming supply zones. But as soon as price tapped into a demand zone, and this demand zone had enough power to reverse the price and create a change of character, you will want to see demand trades because demand did a change of character to the upside and took over control from supply. You will want to trade the controlling side of the market, which is demand in this case. So you will have room between this supply zone, which was the last supply zone before the demand tap. So you will have room between this supply zone and this demand zone to trade long side opportunities. And as soon as price steps into this supply zone, you will want to see short side opportunities. But if price doesn't give you the right opportunity to execute short trades, so supply trades, and it breaks through this supply zone, you will want to trade the contrarian side of the market again, which is demand in this case again. And you will also have a room between this demand zone and this supply zone to execute long trades. So yeah, you always want to trade the controlling side of the market. This is one of the most important things in supply and demand trading to master, to understand what is in control and where you can execute the trades and what can be your TP. And your TP could be always the unmitigated supply or demand zones. Hello, welcome in the next video. This video will be about when should you wait for the confirmation entry and when can you use the risk entry. Okay, let's begin. You should always check if price is coming from an unmitigated zone or not. As I said in the previous video, you want to trade the controlling side of the market. If you are waiting for a demand trade, but price is coming from an unmitigated supply zone, supply is in control, and you can't execute a demand trade without a confirmation because there could be a high chance for you to get stopped out. Okay, let's see an example for when can you use risk entry and when should you wait for confirmation entry. As you can see, price is moving in a downtrend here, creating series of lower lows and lower highs. Supply was in control because supply was formed continuously, but price stepped into a demand zone. And after the demand test, price broke through the last supply zone and created a change of character to the upside. And as I always say, if price breaks through a zone, an opposite side zone will be automatically created. So price broke through a supply zone, so a demand zone was formed. After the tap of this freshly formed demand zone, price created a break of structure again to the upside with inefficient movement. Okay, after this, if you want to execute a demand trade here and follow the trend, you have three possible scenarios. If price taps into a supply zone, comes up here, reverses, then supply will be in control again, and you can't execute a demand trade without any confirmation because you always want to trade the controlling side of the market. And if supply is in control, you can't open a demand trade because there will be a high chance for you to get stepped out. So in this case, you should always wait for confirmation entry. We will talk about confirmation entries in the next unit. Okay, the second scenario, if price reverses before this supply zone and does not tap into any supply zone, then you can open a risk entry here without any confirmation because demand is still in control and you can easily target the next unmitigated supply zone after the tap of this demand zone. So once more, if price reverses before this supply zone, you can easily open a risk entry here and target the next unmitigated supply zone because price did not tap into any supply zone, so demand is still in control. So the third scenario is if price breaks through this supply zone and does not tap into any supply zone, so demand will stay in control, then you can execute a demand trade again on this zone because demand is fully in control because it broke through the last supply zone. So these are the three possible scenarios. So once again, first one, price taps into this supply zone, reverses, then you can't open a risk entry here because you should wait for a confirmation entry because supply is in control. The second one, if price reverses before the supply tap, then you can easily open a risk entry here because demand is in control and price did not tap into any supply zone. And the third one, if price breaks through this supply zone, demand will be fully in control and you can easily open a risk entry on the demand zone. Okay, let's see a live example for this. Okay, so let's see an example, a live example for the risk and confirmation entries. So as you can see, price was moving in an uptrend, creating a series of higher highs and higher lows, higher highs, higher lows. And in an uptrend, price will form demand zones. So we have this really valuable demand zone right here because it created huge inefficient push to the upside. This inefficient push created a break of structure and swept some liquidity from this region and created liquidity here just above the zone. After this, price did a pullback here. And after the pullback, it created a break of structure to the upside again from this demand zone. But actually, I refined this zone on the 5-minute chart because we are currently on the 15-minute chart. But we'll talk about refinements in the next video. Okay, so we have this demand zone that created the last break of structure to the upside. And this break and this demand zone pushed the price up to the supply zone. Because we have this supply zone up here, because price was moving in a downtrend. And now price is in the pullback phase in the uptrend. So it's on the way up to tap the supply zone. So after a supply tap, supply took over control from demand. So you can't open a risk entry on this zone or this zone. You will have to wait for a confirmation entry, some change of character, and after you can open a demand trade also on this zone too. So let's see what happens. Price reacted on this supply zone, as you can see, strong rejection. So supply is in control. If price breaks through this zone, supply will be fully in control because it broke through the last demand zone. So after a zone breaks, an opposite side zone will be created. So if this demand breaks, supply zone will be created. Let's see what happens. Very strong momentum. As you can see, price broke through this demand zone. So a supply zone has been created. And this supply zone caused the order flow that led to a break of structure and change of character to the downside, and it broke through the last zone. So we can't open a risk entry here because we have to wait for a confirmation entry. Let's see what happens. Supply is fully in control. So supply is still in control. Let's see what happens. Okay, price tapped into the supply zone, as you can see, and had a reaction and some rejection. So this means demand is in control now. And we have this supply zone up here that caused the tap of this zone with inefficient push, as you can see, and break of structure to the downside. And actually it swapped some liquidity from this region too. So this is a really valuable supply zone. If price steps into this supply zone and rejects on it, supply will be in control again. But if price breaks through this zone, demand will be in control again, and the demand zone will be formed because it broke through an opposite side zone. Okay, let's see what happens. As you can see, price stepped into this zone and had a reaction. So supply is in control now. If price breaks through this zone, demand will be in control and the demand zone will be formed. Okay, price broke through a supply zone. So demand zone has been formed here, as you can see. We have this demand zone right here. Let's just extend the zone and play price forward. So actually you can open a long trade on this zone because this was the confirmation entry. Price broke to the last supply zone. So demand has been formed. So a confirmation entry has been happened, and we can target the next unmitigated supply zone, as I said. So this will be our target point. Let's see what happens. Price tagged us into the trade, had a reaction. So demand is in control, as you can see. Price reacting strongly on this demand zone. So we are in the trade, creating series of higher highs and higher lows, respecting demand zones over and over and over again. I will just extend these zones. Let's see what happens. TP hit. So as you can see, this is how can we use the risk and confirmation entries, knowing the fact who's in control for our advantage. And this is a really, really strong weapon. So you have to master it and master everything about the control side, because you always want to trade the countering side of the market. Okay, meet you in the next video. Welcome. In this video, we will talk about the refinement. What do we call a refinement? When we have a higher time frame supply or demand zone, we want to check if we can make that zone smaller on the lower time frames. We will use two types of refinements, the 4-hour to the 50-minute and the 15-minute to the 5-minute. The 15-minute chart or the 50-minute time frame is moving in a downtrend, creating series of lower lows and lower highs. This means we will have supply zones. Let's say the upside candle of this movement created the inefficient move to the downside and the break of structure. So we will have a right and valid supply zone. If we switch to the 5-minute chart, inside of this 15-minute supply zone, we will find a much smaller zone because the 5-minute candle before the inefficient push will be significantly smaller, and we can use this zone as our 5-minute refinement. So if we correlate the timeframes, we will have this bigger 15-minute zone, and inside of that bigger 15-minute zone, we will have a much smaller 5-minute zone. So this is what we call refinements. Okay, we're on the live chart. I usually do two types of refinements. The first one is the 4-hour zone refinement on the 15-minute, and the second one is the 15-minute refinement on the 5-minute. But if I refine the 4-hour zone on the 15-minute, I just keep it that way, and I won't refine it again on the 5-minute. So I only refined those 15-minute zones on the 5-minute, which were not refined from a 4-hour zone. Okay, as you can see, currently we are on the 15-minute chart, and I will show the 15-minute to the 5-minute refinement first. Price was moving in an uptrend here, creating a series of higher highs and higher lows. After this, price changed character to the downside with these two inefficient candles. So we have the first POI on the 15-minute, this one, because this is the less recent candle before the inefficient push and the change of character. So I mark this zone out. If I switch to the 5-minute chart, you will see that inside of this 15-minute POI, this big box, we will have a much smaller box, this one, because the inefficient push on the 5-minute started from this candle. So we almost halve the size of this zone. With these refinements, you can have much smaller zones and you'll have a more precise area of the possible turning points or target points. So if you were in long trades, for example, from here, you will target this area, this 5-minute refinement, and not the 15-minute, and you will have a higher risk-reward ratio. And if you are waiting for a turning point, you will aim for this 5-minute refinement and not on the 15-minute, because you know that inside of the 15-minute POI, you will have a smaller 5-minute POI, and you will wait for a reverse point on this 5-minute POI. This is the power of the refinements. Let's see this on the 4-hour to the 15-minute chart refinement. Before we continue with the 4-hour to the 15-minute refinement, I want to show you what happens if you get two unmitigated 5-minute zones inside of the 15-minute zone. So if you see two unmitigated 5-minute zones inside of the 15-minute zone, you just want to keep the unrefined 15-minute zone. And if one of the zones are mitigated, you can use the other 5-minute zone as the refinement. So as you can see, price is moving in an uptrend here, creating a series of higher highs and higher lows. We will have this 15-minute zone here because it created a breakout structure to the upside with an inefficient movement. So we can safely mark out this 15-minute zone. If you want to refine this 15-minute zone on the 5-minute, you will see two different 5-minute zones inside of this 15-minute. The first one is down here. The second one is up here. The first one has been already mitigated by price. So this means you can safely use the upper one as the 5-minute refinement. But if price didn't mitigate the first one, so it has been left unmitigated, you can't use double zones. You will have to use the full 15-minute zone as your demand zone. So you can't refine it. Okay, let's see the 4-hour to the 15-minute chart refinement on the live charts. You can also apply the double zone rule on this one. So let's see an example. As you can see, price created this demand zone right here. It created an inefficient push to the upside, breakout structure here, change of character here, liquidity from here. So this is a really valuable zone. Okay, let's see the refinement of this zone on the 15-minute chart. Let's find that zone. As you can see, this is that 4-hour zone. And inside of this 4-hour zone, you will have two different demand zones. The first one is up here. As you can see, this created inefficient push to the upside. Here, breakout structure and liquidity sweep. So we have this first 15-minute POI inside of the 4-hour. We have a second one down here, as you can see. This one, because it also created breakout structure to the upside with an inefficient move and liquidity sweep. But this zone has been already mitigated by this movement. So this means you can safely use the upper zone, because as I said, if you get two zones and one of the two zones is mitigated, you can safely use the other one. So in this case, the other one is this one. Okay, you will want to see some rejection or reaction on this zone inside of the 4-hour POI. Let's just extend this zone and search for a reaction. As you can see, price perfectly tapped this zone, perfectly tapped it with this wick, and after the tap of this zone, it rejected and reversed the price to the upside. So this is the power of the refinements, because as you can see, price has already tapped this zone, the 4-hour one, but it didn't mitigate the full zone and didn't mitigate the 15-minute zone. So it had to come down to mitigate the 15-minute zone inside of the 4-hour. This is the true power of the refinements.